Okay, this video is about converting a company that uses the LIFO cost flow assumption to FIFO. And companies are required to show investors how to convert LIFO to FIFO if they use LIFO. So first I'm going to show you that rule. Then we're going to do an example of how you would convert LIFO inventory to FIFO inventory and LIFO cost of goods sold to FIFO cost of goods sold. So here we go. First of all, there's something called Regulation SX. Let me move myself up in the corner here. Regulation SX tells public companies what they're required to disclose in their financial statements. So in this part of Regulation SX, here's what it says. If LIFO inventory method is used, the excess of replacement or current cost over stated LIFO shall, if material, be stated parenthetically or in a note to the financial statements. And so now I'm going to show you why when they say replacement or current cost, they mean FIFO. So let's have an inventory bucket here. And we're going to be selling basketballs. So we buy some basketballs to sell. We buy 1, 2, 3, 4, and 5 basketballs. So here's our inventory. And we bought these basketballs over time. So the cost to us, the basketball selling company, is increasing, or it's probably increasing over time because of inflation. So the cost to us is probably increasing over time. But whatever the case may be, the latest basketballs that were added to the bucket reflect the current costs to acquire a basketball. And the earliest basketballs that we put in the bucket reflect the historical costs, so what the costs were a long time ago. So what method is it so that the inventory balance reflects current costs? Well, if we want the ending inventory balance to reflect current costs, we should be getting rid of the older basketballs first. So if we get rid of those older basketballs, then the ending inventory that we have left is more reflective of current costs to acquire basketballs. So when the SEC says replacement or current cost over stated LIFO value, what they really mean is FIFO. So to reread this requirement, the LIFO inventory method is used. The excess of FIFO over stated LIFO shall, if material, be stated parenthetically or in a note to the financial statements. So let's take a look at a company that does this. And the company we'll use is Sherwin-Williams. And the Sherwin-Williams color of the year was navel. So maybe I should paint this room navel. This room is kind of an ugly yellow color. So navel would probably look pretty good in here. And Sherwin-Williams, what is their inventory? It's probably paint. And what I will tell you is that they use LIFO for some of their inventory. So let's take a look at their disclosure. So the company uses LIFO, and the following table, this is in a footnote to Sherwin-Williams financial statements. And the following table summarizes the extent to which the company's inventories use the LIFO cost method and presents the effect on inventories had the company used the first in, first out, or FIFO inventory valuation method. So percentage of total inventories of LIFO is 72% in 2019. 72% of Sherwin-Williams inventory is accounted for based on the LIFO method. And sometimes it can be confusing to say, what does that 72% mean? Well, let's say Sherwin-Williams sells paint and then they sell, I don't know, painting equipment. Well, if paint is most of their inventory, say paint is 72% of their inventory, and they account for paint using the LIFO method, and they account for equipment using the FIFO method. Well, since 72% is paint and that's LIFO, that would be what this disclosure is talking about. So the 72% of their inventory is accounted for using the LIFO method. And here they have something called excess of FIFO over LIFO of 339.8. And that number right there is going to be called the LIFO reserve. And they're reporting it to you for the past 3 years. So now let's do some just exercises. And the first thing we're going to do is we're going to convert Sherwin-Williams inventory balance from what is a mixed inventory balance with some LIFO and some FIFO, presumably, to all FIFO. And so let's take a look at their balance sheet. So in the asset section of their balance sheet, one of the current assets that they report is inventories. They've got finished goods and work in process and raw materials. And their total book value of inventory at December 31st, 2019 is 1889.6. So that is their inventory balance. That inventory balance is calculated using 72%, well, 72% of that inventory balance is accounted for on a LIFO basis. And the remainder is accounted for probably on a FIFO basis, but some other basis. So we want to convert this to what would it be if it were 100% FIFO. And to do that, you just use an equation that's in our textbook and it's in all the course materials. You take your LIFO inventory. In this case, it's kind of a mixture, but the equation works fine either way. You take your LIFO inventory, add the LIFO reserve, and you get FIFO inventory. So we'll take LIFO inventory of 189.6. We'll add the 2019 LIFO reserve of 339.8, and we end up with a new inventory balance. And that's what it would say on the balance sheet if Sherwin-Williams had made the choice to use FIFO as their inventory cost flow assumption. So 229.4 would be their FIFO inventory. Okay, now let's calculate what FIFO cost of goods sold would be. And what we're going to need here is the income statement. So we have their cost of goods sold for the year ended December 31st, 2019, and it's 9864.7. That's their mixture LIFO and FIFO cost of goods sold. So to calculate FIFO cost of goods sold, we need to take that LIFO cost of goods sold and subtract the change in the LIFO reserve. So this here, this delta, this triangle is called delta, and it means change. So the change in the LIFO reserve needs to be subtracted from LIFO cost of goods sold to arrive at FIFO cost of goods sold. So this is LIFO cost of goods sold, and we're going to subtract the change from 2018 to 2019. The LIFO reserve went down. So we'll take 9864.7, which is the LIFO cost of goods sold, and we'll subtract the change. So new minus old, 339.8 minus 377.1. That's going to be a negative number. So we subtract a negative number, and FIFO cost of goods sold is actually going to be higher than LIFO cost of goods sold in the case of Sherwin-Williams. Okay, so that was the exercise, just converting LIFO inventory balances to FIFO and LIFO cost of goods sold to FIFO.